We just had the best episode ever of the Ask Bob Mortgage Show. It's probably because it was our first episode. You have questions, I have answers. Great question.
What I want to be able to do is give you world life experiences that I've been going through.
What we do with the Ask Bob Mortgage Show is we put out information out there to the public. We get asked a lot of questions, and I want to be able to provide a venue to be able to answer those. So for you guys out there on Instagram, Facebook, Twitter, YouTube, ask your question and then just put a hashtag AskBobMortgage. And what I'll do is every week I'll come in and I'll answer them on the Ask Bob Mortgage Show. So speaking of that, first episode, what's our questions?
First question is from Fortitude 1906 on Instagram, and they ask, does changing mortgage companies affect your credit score?
Okay, great question. So changing mortgage companies, it can affect your credit score if it's after 30 days, right? So let's say you're looking to buy a home and you have 3 different mortgage companies that you want to maybe shop interest rates or compare fees or loan programs on, right? And each one of them is going to want to pull your credit report. Well, in the first 30 days of that pull, the credit bureau's FICO is going to treat each of those pulls as one pull. Okay, where typically those credit pulls would deduct about 2 to 5 points off of each pull. But for mortgages, in the first 30 days, each pull will represent one inquiry. So you're only going to be impacted, 2 points for those three pulls. So that's Fortitude 1906. Mm-hmm. All right, love my Instagram peeps. Thanks, Fortitude 1906. Hopefully that addresses your question. All right, what we got next?
Okay, next question. David from Garland. This came from your radio show.
He says he wants to buy multiple rental properties, but most of the properties he's finding require work and don't have enough money to buy multiple homes plus repair those homes. Are there any options out there to help?
All right, that was David from the radio show. Mm-hmm. David, awesome, man. Much respect if you're thinking about getting into buying multiple rental properties. So yes, Fannie Mae has a loan program called the Homestyle Renovation. Now, what we do there is we can roll in the cost of the repairs. All right, so David, let's say you're buying a $150,000 home. Now, typically on an investment property, you'd have to put 20% down on that $150,000. Then you would also have to pay let's say $50,000 in repairs that you wanted to put into that home. So that's a pretty significant amount of money. But with a homestyle renovation, we can take that $150,000, add in the repairs of $50,000 into that one loan. So now we're at $200,000, and then we take a 20% down payment off of that, which is going to be $40,000. So the savings could be pretty substantial, which would allow you, David, to buy more rental properties because you're not tying up all your money with the actual repairs themselves. So it's a great way to buy multiple rentals and have just a much lower out-of-pocket expense. So hey, good job, David, on thinking through asking that question and wanting to buy multiple rental properties. All right, what do we got next?
Next, we got Kevin, and they asked from LinkedIn, do you recommend refinancing into a 15-year mortgage or paying extra principal on a 30-year fixed?
So Kevin, it's going to depend on a couple of things. It's going to depend on how long ago did you buy that house, right? Because, if you bought it 10 years ago and you're asking me, should I refinance to a 15-year or put money down towards a principal balance? I'm going to tell you to probably put money down towards a principal balance because you're already 10 years into a 30-year mortgage. We're only going to be saving you 5 years off of that balance anyway, so it might not make sense. Other thing is going to be what is your current interest rate now, right? I mean, if you're at a pretty high interest rate and you're 3 to 5 years into your 30-year fixed rate now, then more than likely it's going to make sense because interest rates are still, based on historical levels, still really, really low. So I'm looking at refinances right now to decide, what's the lowest total cost of ownership that we can get into it, because there's still cost in refinancing like there's cost in purchases. You just don't have your down payment. So I want to make sure the interest savings is going to be substantial enough to give you the lowest amount of interest over the period of time that you're going to keep that loan. So if you plan on keeping it for another 12 or 15 years, then yeah, let's look at refinancing that loan. But if you're only going to keep it 3 to 5 years, it's probably not going to make sense to refinance it. I'd probably tell you save the refinance cost and really put more money towards that principal pay down. You can shave 9 years off of your loan with just an extra payment towards a principal balance every year. Okay, hopefully that answers your question, Kevin. It's a great one, by the way.
All right, next we have MJ on Twitter, and they ask, I don't have any money, but my mom will give me over $15,000 to buy a house. Can I use that money to buy a house, or do I have to have my own money?
No, MJ, that's a great question, and get out of renting. That's the number one thing. So if you have a family member that's willing to gift you money, that's what we call it in lending world, as a gift. But if she's giving you money, $15,000, then absolutely we can use that money. We'll treat it as a gift. Now there's documentation that we have to go through to make sure that we document the transfer of that gift properly. But we can use that to cover your down payment. We can use it to cover your closing cost. And let's say for some reason, based on the size of home that you're looking to buy, the $15,000 isn't going to cover everything. Well, we can have it go towards down payment, and then we can get a grant to even cover the closing cost. We've had loans where we've provided to individuals where they get in for no money out of pocket, whether that's a combination of the down payment from the gift from their family member and combining it with a grant, or just straight out grant. So MJ, right?
Correct.
Yeah, so MJ, absolutely the money can come from family members. It can be used towards the down payment. It could be used towards the closing cost. And then there's also other ways to get that out-of-pocket expense even lower, combining it with a grant. So any other ones?
No, that's it.
All right, so there's your first Ask Bob Mortgage Show, and it was the absolute best Bob Mortgage Show we've done yet. But we certainly appreciate everybody tuning in. Please ask your questions on any of the social profiles. Hashtag us at #AskBobMortgage. Now, one thing I want to do is question of the day. Okay, so I want to throw out a question of the day. So for those of you that hung in for this video, good for you, because there's a question. I want to know, what's the single most important thing that you look for when making a decision to choose your mortgage advisor? So the single most important thing you're looking for in choosing your mortgage advisor, what is it? I want to know in the comments. Leave me the answers. All right, you keep asking questions, and I'll keep answering.